Good morning, everybody. It is Monday, once again, July 27th, and here's what's on today's agenda. Oil drops as attacks in the Middle East pause. Ahead of a big week for tech earnings, we track news on memory prices, IPOs and financing. And how are the world's central banks keeping up with volatile energy prices? We look ahead to the Fed, Bank of England and BOJ decisions.
OK, let's talk about these markets in a little bit more detail, Anna. Brent crude is down hard, 5%. That is the move that we're seeing on the screens this morning. There was a pause in fighting between the United States and Iran, though there appears not to have been a pause in the fighting between the Houthis and the Saudis over the weekend. Pay attention to that and what's happening in the Red Sea. Brent note down by 2%, by 5%. That's translating into actually some quite positive vibes here in Europe this morning. Euro Stoxx 50 futures are up by 0.9%. US futures are also sharply higher. I should point that out. And the euro looks like it's a fairly big beneficiary of this as well. Europe obviously energy dependent, and as a result of the drop that we're seeing in crude this morning, that is translating into a positive picture. We're up by a third on what we are seeing when it comes to euro dollar. Lots to talk about. The countdown to the opening trade starts right now.
Good morning, everybody. Welcome to the programme. Monday again, and volatile energy prices once again. This is the picture across European, or rather global energy markets. We are weaker on the oil price and on the gas price, as Guy was just mentioning. The oil price then at 91.60 on Brent, down by 5.4%. Guy, we've been weaker than this overnight. We dropped down to more like $90 a barrel, but we bounced a little from that. It is interesting because, yes, there's this lack of clarity really about what the Houthis are up to. The Houthis have said that they've targeted 2 Aramco ports at Jizan and Yanbu on the Red Sea side, but we haven't had much commentary from the Saudis. There's the lack of clarity there. So in the absence of clarity there, maybe we focus on the fact that we have got this pause. We've had 13 nights of consecutive tit-for-tat strikes, and now that seems to at least pause in the short term, and there does seem to be some space for talks. The security advisor in the US saying that President Trump has paused this because he wants to create space for talks, and that there are talks taking place at a technical level and at the highest level. So that's the sort of glass half full, weaker oil price scenario.
There is another narrative which is being pushed as well, which is basically that the US is running out of interceptors, that it can't carry on expending this level of munitions in a conflict that is open-ended at this point, as a result of which you have to see a pause, and that is it's simple, it's just logistics. You can't continue to fight the war at this kind of level if you can't produce the interceptors at that kind of speed. So that's one narrative that is taking place as well. The oil price I find fascinating. Ships aren't moving very much. So, actually, what are we responding to here? The Red Sea story is really interesting. The Saudis apparently have struck back as well. You're right to say that this is all speculation because the details are scant. But the Red Sea is still in the mix, and very much so. And that seems to be the latest catalyst and is not going away. So, what has really changed from Friday into Monday? Yes, maybe we're not seeing the same level of strikes, but we're also not seeing is ships transiting. Yes. And that is the critical factor here when it comes to the energy markets.
Yes, ships not transiting, that's the critical factor for the oil markets. And absolutely, this broadening, which we talked about at the end of last week, geographical broadening of our area of concern, not just the Strait of Hormuz, despite the fact that the Omanis and the Iranians have been talking over the weekend about that. Well, now we have to worry about the Red Sea. So that's all of the oil price for the moment, much weaker, down by 5.5%. We have a big week ahead of us on central banking, but also on tech earnings, Guy. And it's interesting to sort of take the temperature of where we stand ahead of these big tech earnings.
I'm not ready to talk about the big tech earnings yet, because I think they're quite distant in a market that is still struggling to deal with narratives that are in the here and now. Yes, I think we're going to get updates from some of the big tech companies. They're going to tell us a lot about what's happening on the spending front. You've seen a big IPO in China overnight that has come through and delivered significant upside. It was probably underpriced. Normally you blame the bankers for this. This is CXMT. It's rallied circa 500%. The Chinese authorities clearly have kept the valuation low, so you're seeing a big pop at that IPO. That's not what they wanted. They're just trying to put maybe more realistic expectations into the market. So you've had that happening as well. But Friday was really interesting. Big drop in Intel. You're seeing NAND pricing coming under pressure. You've seen these huge drops increasingly coming through when it comes to the memory producers. They have been the drivers of this market over the last few weeks and months. We know what the hyperscaler story is. The hyperscalers are making the market nervous. Anything that changes that narrative later this week will be significant. But for the moment, I just wonder whether the focus is actually on this chip rollover and whether or not that has steam to the downside. And if it does, this market's starting to look a lot creakier.
Yeah, absolutely. And Anthony Stevens, I know our colleague, has been focusing on this drop in NAND prices and even suggesting this could be some kind of canary in a coal mine. Joining the dots between this really interesting story and the earnings story,
Yep.
There is a link, of course, isn't there? Because what kind of capex do you want to see from these big companies if we are seeing some downward pressure on some of the other elements within this story, in this supply chain around NAND? So that is interesting. Nvidia is also a really interesting story as well, isn't it? Nvidia in talks to possibly provide OpenAI with some support on its lease for a SoftBank data center over in Ohio. This has become the poster child for the big AI build out in terms of data centers. It would be the largest in the world, this data center. So what does this portend about our confidence in this? Is it just Nvidia has a lot of confidence in it, but then it prompts questions about the circular nature of some of these deals between the likes of Nvidia and OpenAI.
I think you're being very polite saying that it prompts questions. It is raising red flags about circularity and whether or not actually this is something that you can really rely on, and whether or not, if it were to unwind, how significant would the consequences be? So yes, all of this in the mix this morning before we get to the hyperscaler earnings stories that are going to come through midweek.
Yeah, and that's sort of the backdrop to them, isn't it?
Yeah.
It's that sort of nervousness. I mean, what does it mean for what looks like a good number and what looks like a bad number? Let's talk about central banks, because we've also got a really big week for central banks, and we've got a central bank in the States that doesn't want to do forward guidance anymore, or at least a Fed chairman who doesn't want to do forward guidance anymore. What's changed since June? We've had a much better inflation picture in the States since June. We had a drop in the June CPI, mostly due to gas prices, which prompts what happens now, as we've seen gas prices on the rise last week, of course. But we've also seen tariffs back. We've seen the AI boom continuing. What does that add up to in terms of an inflation-fighting narrative from a Fed chair who just wants to say, yes, we are absolutely going to bring inflation back down, but not really talk about much of the detail or the reaction function? Is
the market mistaking a lack of guidance as hawkishness, which is an interesting point, I think is going to be one that we should discuss in this show. And kind of, are we not spending enough time talking about a labour market which looks quite strong? The claims data, and I'm fascinated to see Thursday's claims data to see whether it repeats what we got last week. Last week was the lowest number, I think, we've seen since the 60s. So the labour market, in theory, looks quite strong. If you have such strength in the labour market, presumably with above target inflation, the onus to hike is there. And if you look at the work function on your Bloomberg, 31.5 for this week, 64.8. The market is definitely pointing us in the direction of rate hikes. The question is, if they don't come this week, will the market start to assume that the Fed is behind the curve? Right, yes. And what will we think about other central banks and whether they are behind the curve as we see the energy prices? OK, so we've dropped from $100 a barrel, but we're still at 91 on the Brent handle. The Bank of England, how will they be thinking about the oil prices? We're working up to another interesting budget, and the politics, of course, all looking quite changeable in the UK. The Bank of Japan also in focus after we saw last week that really fascinating story that the BOJ is ready to move faster than the market had anticipated, or at least faster than its recent cadence of every 6 months. So that's interesting as we approach the BOJ. But we have other corporate earnings to focus on. We do. AstraZeneca is out with numbers first thing this morning. Huge heavyweight when it comes to the FTSE 100. Definitely worth paying attention to. The CFO will be on our air very shortly. Astra's Q2 EPS 2.63, estimate 2.48. We are well ahead when it comes to the EPS number, on track to deliver its ambition of $80 billion in revenue by 2030. This is a company that is pushing very, very hard when it comes to the top line. What kind of demands is that going to place in terms of the working capital that's going to be applied to this business and the investment needed? Yeah, and it's interesting they're confirming that target, not upgrading that target. No. Some people are starting to wonder whether that looks quite achievable, that target, as big as that number might be. And it is 2030 we're talking about here. But lots to think about in terms of their performance on recent trials around heart medication, around obesity, the Chinese market in focus, M&A in focus. So lots to discuss when it comes to AstraZeneca. Yes. Big lean on China as well, which is an interesting aspect of what they are doing over at AstraZeneca CFO, Arahana Saran. 7:45 London time on our air. Looking forward to that conversation. Coming up, highlights from Bloomberg's exclusive interview with the Nvidia CEO. We'll bring you his view on the growth of South Korea's chip industry, the importance of a speedy build-out of AI infrastructure, and much more. Plus, wildfires continue to rage across areas of Spain and France. More on how an upcoming heat wave is set to complicate efforts to extinguish the flames and what the governments are trying to do about it. Up next, we will be joined by Naomi Fink, Chief Global Strategist at Amova Asset Management. That is ahead of the BOJ meeting, but also with the other context that we've just been discussing. If you want to be part of these conversations, please do make contact with us. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Here in London. So this is the futures picture for European stocks. We're factoring in a substantially weaker oil price this morning. We are down by 6% on the Brent price now with a 90 handle, 90.94. That's the area of positivity, and that's what we see in the European futures picture this morning. Nasdaq futures, interestingly, up by 1.5%. E-minis up by 0.9%. So this continues stateside. Let's focus on the driver from the commodities perspective. Oil and European gas sharply lower this morning, with the US and Iran pausing an almost 2-week run of tit-for-tat strikes. Speaking to NBC's Meet the Press, UN Ambassador Mike Waltz said President Trump is allowing for diplomacy.
The president is keeping all options on the table. I've spoken with the negotiators. I've spoken with Secretary Hegseth. What the president is doing right now, as we've seen all along, is giving some talks, some space. Talks are ongoing. They're happening at every level, from the more technical aspect of it all the way to the highest levels, of course.
For more on this, let's bring in Bloomberg's Abir Abu Omar, who's in Dubai for us. Talk us through the latest then, Abir. We spent last week worrying about the geography of this broadening to the Red Sea. The weekend has been thankfully pretty calm in terms of these tit-for-tat attacks between the US and Iran, at least.
Good morning, Anna. Yeah, after 13 straight days of consecutive attacks by the United States on Iran, they seem to have stopped. Now, this is without any explanation from the United States. The New York Times did report earlier that it could be to diminishing munition from the United States side. President Trump later told the Wall Street Journal that that is not true, that the munition is sufficient from the U.S. side. But when it comes to the movement in the Strait of Hormuz, is still very much paralyzed, Anna. That is something to distinguish. So between what markets are interpreting and what is happening on the ground, the movement there is still not happening. What we know from the Iranian side is that the deputy foreign ministers of both Iran and Oman had met over the weekend to discuss shipment through the Strait of Hormuz. Now, we don't have any clarity on what exactly happened in that meeting, and Iran did come out of those joint meetings in Oman over the weekend and said that traffic is still constrained in the Strait of Hormuz. And despite the United States not hitting Iran over the weekend or over the past couple of days, the naval blockade is still very much in place. So while what is happening over the weekend, or what has happened over the weekend, is positive in essence, it could all unravel, really, Anna. And just something to remember is that the deadline for the temporary ceasefire that was reached in Switzerland in June is fast approaching. We're looking at August 16th, and all those concessions, the 14 concessions that we have spoken about multiple times over the past couple of months, are not being discussed, including the nuclear component, President Trump's main goal. We seem to now have seen all these concessions take a backseat, and one thing is front and focus, and that is the Strait of Hormuz and the movement there, or the lack thereof. So still a very fluid situation that we continue to monitor over the next few days or a few weeks at this point as those discussions continue to happen.
Abir, thanks for the update. Greatly appreciated. Abir Abu Omar joining us out of Dubai. Joining us now, Naomi Fink, Chief Global Strategist at Amova Asset Management. Naomi, good morning. What do you do with an oil price that is this choppy? Up a lot last week, down heavily this morning. Gas prices in Europe are down 8-9%. What do you do with that? How do you plug that into your models, into your portfolios?
Well, I think one thing is clear, and that's we can't suddenly assume that everything depends on a sudden decline in oil prices and going back to a pre-war situation. Even if we do see a decline in oil prices, it's clear that the situation is very fluid, and we might see a rebound. And even if we do see some settling down in oil prices, the conflict has lasted longer than initially assumed by markets, I think, and there's no imminent end in sight. There may be an end sometime, but now we have to start getting concerned about some knock-on inflationary expectations being baked in, and that's not only in one country, that's across the world.
Okay, so factor that all in as well to a central bank story for me. If you're the Fed, the Bank of England, if you're the Bank of Japan this week, what do you do with this?
Well, I think that there's probably an inherent tension. So first of all, no central bank just wants to react to a move that may be temporary. So I think usually if you see a one-off surge in oil prices, central banks would want to look through it. But now it's becoming more apparent that that's not what this is necessarily. Yes, we may eventually see a decline again in oil prices, but there are some knock-on effects already happening. So I think the central bank's challenge is to figure out how it's reflecting in inflation expectations more broadly. And so while central banks will probably not be in a hurry to hike rates sooner than they need to, they also probably need to signal quite a lot of caution over inflation and inflation expectations. So that's what I anticipate that central banks will be doing this month.
So, Naomi, good morning. So if we're looking at a slightly higher inflation environment on a global level, and if that means central banks are going to be there looking for these second round effects and then possibly delivering some hikes, what does that mean for the cost of money that we should be factoring into investments? I'm thinking here about stocks and whether the strength of the AI story is going to be troubled by this.
Well, there are already some inconsistencies happening between asset markets. For example, if we break down the U.S. Treasury curve, there seems to be some elevation of inflation expectations and also some expectations that the Fed will keep rates higher for longer. So some of those expectations are being a little bit baked in, and the longer end of yield curves worldwide has been under pressure. But you wouldn't really notice that if you were to only look at stock markets and assumptions of cost of capital. It seems like the stock markets are really assuming that the cost of capital stays low. So they probably aren't both right. And if the bond market and the central bank caution is merited, then it's possible that equity markets will have to adjust to admit a higher cost of capital.
And when does that start to dawn, Naomi? How long do we stay in this, either with the tit-for-tat attacks returning, but, effectively the Strait of Hormuz closed? How long can that last without us seriously rethinking the cost of capital as it relates to tech stocks?
Well, I think that market timing is probably the trickiest thing that we have. So we have a lot of things now that are clearer than they were at the start of the conflict, including the fact that inflation expectations, for example, pass through of some of the oil price rises. That's being affected. So although that's clear, that's not an immediate catalyst, for example, for investors to suddenly abandon their risk tolerance, which is also another big factor in the current rally. I think maybe it's important not to get confused the investment that is going on, which does tend to happen during innovation booms. So it doesn't. It may happen even before the productivity is broadly realized. I think we need to stop confusing the investment with the eventual productivity. Usually what happens during these large innovation investment booms is yes, the investment happens, but then there's a period of disruption, and then only after that is there reallocation, and that's usually when the productivity rises. And so I know there's a lot of narrative about the productivity is already here. I would highly question that. I'm not saying that it will never come. It probably will. It's just that it might be a little over-optimistic to expect everything at once. So I can say that most likely there can be some sort of disruption and adjustment in equity markets. A lot of people don't think it's going to be tomorrow, but could it be the next day? The probability rises the further out you go. And then I think that there will be good prices to buy on dips in that occasion if you do anticipate there's going to be that productivity boost.
How good, Naomi? How good will those prices look versus relative to where we are now?
Well, that still, I have to say, remains another big question mark. I'm not really sure that markets have been too effective at measuring drawdowns before they happen. The thing is, they do tend to happen now and again. So I would probably not want to call the top or bottom here. I would remain invested in the high conviction investments and use the rest of your portfolio to try to make sure that you can hang on to those high conviction investments and not get knocked out of them.
Do you feel that high conviction is something that's now in the rearview mirror? The market is questioning an awful lot right now. The fact that the big chip manufacturers are beginning to roll over pretty aggressively. They've been the big part of the momentum trade, the momentum driver that we've seen over the last few weeks and months. But the market's calling that into question right now. How easy is it to have a high conviction trade at the moment?
I think you can still have high conviction investments. And I would think that high conviction probably means more a micro decision. So you believe in a company's business model. You think that they have a lot to offer. You are comfortable making a long-term investment, knowing that markets may disagree with you along the way. What you might want to look out for are periods where a firm, for example, will need to ride out changes like a rise in the cost of capital or risk aversion or some of those capacity issues in the tech boom too. You know, it might seem like you're one moment you have insufficient capacity and then the next excess, but sometimes it tends to level out longer term.
Naomi, thank you very much. Thanks for your time. Naomi Fink, Chief Global Strategist at Amova Asset Management. Guy.
OK, what else do you need to know? This Monday morning, China's industry saw profit gains slow for the second month, even as sectors benefiting from the tech boom enjoyed a windfall, adding to evidence of an uneven recovery for companies across parts of the world's second biggest economy. The profits of integrated circuit manufacturing, chips, surged more than 2,500%, and the electronics industry overall made nearly 97% more money than the same period last year. But it's clear evidence that the Chinese economy is struggling right now. The UK Prime Minister Andy Burnham will host Ukrainian President Volodymyr Zelenskyy as his first international visitor. Their meeting at a naval base is a sign of Britain's continued support for Ukraine and will allow UK officials to help Zelenskyy prepare for his meeting with the US President Donald Trump later this week. And firefighters are battling wildfires for a sixth consecutive day in France and Spain. More than 300,000 people have already been evacuated across the two countries, with another heatwave set to complicate efforts to fight the flames. The French President Emmanuel Macron will hold a crisis cabinet meeting later today to discuss the response that we are going to see coming through. The pictures are unbelievable, particularly coming out of Western France and Spain. Yeah, really harrowing, very close to really large population centres. Yeah. We'll get an update on this story later in the programme. Coming up, as the drop in oil prices tempers inflation concerns, we will discuss the outlook for bonds. Becky Chin will be with us, portfolio manager at Fidelity International. This is Bloomberg. Morning, how are you doing? 30 minutes to go until we start equity trading here in Europe. Let's take a quick look at the picture. This is what futures are telling us right now. Fairly positive picture. Europe looks like it's going to benefit maybe this morning from the lower oil price. That's going to get priced in across the continent. We're certainly seeing that in the euro this morning. US futures are, though, really positive. The Nasdaq Mini futures, Nasdaq 100 Mini futures up by, let's call it 1.5%. Under pressure a little bit Friday. Certainly chip stocks under pressure Friday. Yes, absolutely. So that's the stock narrative. Let's have a look at the oil price impact on bond markets, because we're down by 6% on the Brent price at $90 is the handle there. And so we are seeing some of these yields around Europe coming down. And we remember, of course, that on Friday we saw yields coming down by 4 or 5 basis points. And we see something similar today. So 5 basis points in France, 3.5 in Germany, 6 basis points in Italy. So we are seeing the market pricing out some of its inflation concerns on the back of this whippy, seems to be the word we use these days, oil price. Let's bring in Becky Chin, portfolio manager at Fidelity International. Becky, good morning.
Good morning.
How on earth do you keep up with the oil price and the volatility we see here? We got to $100, now we're at $90. Do you have to just have a portfolio that withstands any oil price between 60 and 120? I mean, how do you think about the oil price right now?
Sure. I think our base case for oil price is that there will be more elevated geopolitical risk premium built in it, even at a steady state. And so we're looking at oil price settling in that sort of $85 to $90 range, even if we get a resolution. Of course, it will overshoot on the up as well as the downside, as we've seen with the MOU last time. But basically, we look after multi-asset portfolios, and our clients care as much about the journey as the destination. And so if you look at our portfolios right now, the return-seeking side is really emphasizing a theme of diversification. So the prior guest talked about the tech theme, and I think we still, from our bottom-up equity analysts, still seeing a picture of strong demand outstripping supply in terms of semi and hardware. However, we have been, over the past month or two, incrementally playing sectors such as S&P equal weight or value, dividend stocks, and accompany that with global stocks as well, where in Europe, for example, we're playing the theme of defense, and in Japan, mid-caps. Okay. And with that, on the bond side, we are seeing, for example, Fed that probably will change the way they communicate, and that could potentially lead to higher rates volatility. And so we have been relatively conservative on bonds and seek protection from dedicated hedging portfolios such as options and derivatives.
Okay, so there's a lot in there, and we'll talk about that diversification away from the chip story or the tech story perhaps. But you do think that the European economy has been a bit more resilient than expected to the higher oil price. Does that filter into your expectations for European stocks, for the way that you play Europe right now? How are you thinking about Europe?
Sure. So for Europe, indeed, I think growth has been a little bit stronger than many have feared, and we've seen actually resilience in the labor market, especially in the periphery. But if we talk about Europeans' growth engine is really the industrial sector, and if you look at whether it is unfilled orders or industrial production, and you strip out the defense, aerospace and defense component versus the rest of European industrials, you really see a draw opening there. And that's why in Europe, instead of playing broad equity, we've been a little bit more focused on thematics such as defense, where fiscal spending is actually on track to surpass last year. Whereas the rest of Europe, I think, if you think about literally on Friday, I was checking the TTF gas price was higher than the March peak. Albeit this morning has tanked a little bit, but that energy theme is more or less a permanent headwind for European industrial sector, and added to that is the competition from the Chinese.
And that ties to what we were hearing from AstraZeneca last week. They were saying, permanently. You're saying permanently. He was saying for the foreseeable future, we just have to factor in a higher energy price in Europe,
and that's not good for European industry. So it goes elsewhere. You see it across the board. Like so many areas are struggling off the back of that. Just kind of want to come back to the factor story you were talking about just a moment ago. You're diversifying. I'm assuming you're taking money out of momentum. Is that trade, that momentum trade, on the back burner for now?
So in terms of the momentum trade, obviously the unwinding that we've seen many talk about is sort of the highest since the 1990s. If you just look at, for example, semi versus software, what we've looked at within the factor space is that from a fundamental perspective, as many have mentioned, the bottom-up picture is one where the demand for semi hardware is very, very strong. However, investor positioning has accumulated and led to this momentum unwind. If you look at institutional investors, many levered hedge fund positions have unwound, but if you look at retail investors, I do think some of these levered ETF AUM in terms of flow hasn't fully unwound yet. So it's fair to say that whereas we've believed in the fundamental sector and played the tech story earlier in the year, into the summer we've been lightening that position and putting it a little bit at the back burner, waiting for this period of momentum to sort of stabilize.
Okay, so you look, it's still, and that hasn't happened yet. You still haven't seen the stabilization that you would like to see. I
think it is possible that we have a little way to go, but after the significant unwind, I think investors could start to gradually build a position. But if you look at some of the levered ETF AUM, it's not a full flush out yet.
Okay. In terms, therefore, you also mentioned the diversification trade, but you're not using bonds for for that kind of diversification. How easy is it to construct a portfolio that gives you some degree of hedging without using bonds? Buffer funds are now becoming a big thing over in the United States. They're using a lot of, as you say, options to be able to create some degree of protection. Is that what you're using? Basically, I'm going to give up the top sort of 10% of my portfolio upside for protecting me against the bottom 20. Is that the kind of thing you're thinking about right now?
I think you bring up a very critical point of diversification versus hedging, which we actually see as two separate issues here. Diversification, we like to say it works very well when things are going up, but when things are going down, big spikes, frequently diversification fails, and that's why we dedicate part of the portfolio to just hedging assets, and bulk of that will be option strategies, frequently through downside option protection rather than giving away upside, although we can use both, but also we complement that with interest rate volatility hedging, credit hedging, as well as defensive FX, and so dedicating part of the money to hedging strategies rather than just relying on diversification, I think gives you a portfolio that deals with market up as well as market down.
Yeah, diversification has the danger of relative trades rather than kind of absolute trade.
Yes.
Becky, nice to see you. Thank you very much indeed for dropping by to see us. Becky Chin, Portfolio Manager at Fidelity International. Coming up, Astra's out with numbers this morning, pushing the top line hard. The numbers look like they've beaten cancer, the big driver. The company's CFO is coming up next. This is Bloomberg.
Welcome back to the opening trade. We've got earnings coming in this morning, but the overall picture for European equity markets possibly reflects a drop in oil prices and gas prices, crucially. So we're down by 6% on the oil price. 90 is the handle. We also see gas prices materially lower this morning on the back of a step down, a pause in the tit-for-tat fighting that we'd seen between the US and Iran.
Yeah, Europe is highly geared to this energy story, so it gets a big benefit when we do see such a significant drop. Let's talk about some of the corporate numbers that are out this morning. The big one is AstraZeneca, reporting higher than expected profit, buoyed once again by its cancer oncology stable, which continues to do very well. Focus will now shift to the company's next generation of oncology drugs. Several key clinical trial results expected later this year. We are watching with great anticipation. Here to update us is the AstraZeneca CFO, Arahana Saran. Good morning.
Good morning.
Nice to see you.
Nice to be here.
What should I make of these numbers? Oncology continues to do really well. Is that the takeaway, or is there more to it than that?
I think two main takeaways. One, overall, the company is very much on track for the $80 billion ambition that we had set back in May of 2024 for 2030. Secondly, that we have a very diversified business. So if you look at the oncology numbers, which you just did, 15% growth in oncology, but also very strong growth in respiratory and the immunology space. Some decline in cardiovascular because we are losing Farxiga in terms of our patent, but overall very strong growth. So I think from a pharma standpoint, we are probably one of the most diversified from a product and pipeline, as well as probably the most diversified geographically. So all of those things add up to managing risk and getting to our $80 billion target. Okay,
$80 billion. Everybody, the question I'm sure, and we joked as you sat down, $80 billion. Looks quite achievable now, doesn't it? You're going to get there easily. Why not upgrade the numbers?
I'm not sure it's easily. So just to put that $80 billion in context, when we had given that number for $80 billion, it was a stretch target. It still is a stretch target. At that time, consensus was at $67 billion for 2030.
Yep.
Now consensus is ahead of $80 billion. They're almost close to $81, $82 billion. So I think as time has gone on and we have de-risked more and more studies, people are getting comfortable that we will achieve the $80 billion. If you look at just like the last 18 to 20 months, we've had a 75% success rate on our phase 3 trials, which compared to industry, which is closer to 64%. So I think if we continue on this streak, we definitely hope to get to $80 billion.
Okay. Good morning, Aradhana. Nice to see you. Let me ask you, thinking about those trials, let me ask you about something related to that, because this morning you've also put out some promising results around a gastric cancer, experimental treatment for gastric cancer, but maybe disappointing results around a rare blood disorder for a medicine to treat that. Which is more material? What's the signal in all of that for us, for investors?
The more material one is the product which is called Soni-V, which is an antibody drug conjugate for Claudin 18.2. So within gastric cancers, about 60% of patients actually have this biomarker, which is Claudin 18.2, and this is our proprietary antibody drug conjugate. Think of it as sort of a replacement for chemotherapy in second line and beyond. And, this could be a $3+ billion product. The other one that was less positive, though positive in the pediatric population, was for an additional indication for an already approved medicine called Ultomiris. And we may still look to get a pediatric approval for that.
OK, so that's some of the context around those results. I wanted to sort of link how you think about communication around trial results to what we saw out of Wainua. You can correct me on the pronunciation. You're much better at that than I am. But the heart drug that you had late-stage trial results earlier this year, and the market took quite badly what we'd heard there. Do you have to think quite carefully? I mean, obviously, you do think carefully about what you say. Are you rethinking what you say about these trial results or the stories you tell around the trial results to make sure that the market doesn't run away with itself and get overexcited?
Yes, obviously, communication of any trial results, particularly those that are material, is something we take very seriously and very carefully. But at the same time, there is this in our communication and in the scientific community. When we make press releases, we don't put out all the results, because those results are actually have to be peer reviewed and looked at by the appropriate society, whether it's ASCO or ESMO or ERS, and then presented at a scientific meeting. So in the case of Wainua, and actually in the case of all the studies, even the results today, we only present sort of the top line and saying whether the study was positive or not. But when people see the full results, then they get to understand the detail. But that we only do at a scientific conference.
So we should always wait for those fuller results, perhaps.
Absolutely.
Yeah.
Aradhana, you're placing the company is placing quite a lot of emphasis on top line growth, pushing that pretty hard. What are the implications of that maybe the market isn't recognizing yet? How much are you going to have to invest? What does that look like? Where does it go? Do you think that we have within the market, outside of Astra, we have a sophisticated view of kind of what the implications of that top-line push look like?
Yeah, I would say probably the most underappreciated portion of our story is the beyond 2030 growth. So everybody's focused on the 2030, which we just talked about, the 80 billion. But it's actually also the growth beyond 2030. And I'd say that's probably where we're most underappreciated. So pharma industry on average grows about 2 to 3% top line.
Okay.
Our expectation is, between this decade will grow 5-6% on a CAGR basis, and we will maintain that level of growth, which is sort of top quartile, in the next decade as well. So what that means is products like Soni-V, where we just announced the results, we need to continue to invest about 24% of revenue into R&D to not only get to 80, but continue 5% growth beyond 2030. Again, think of, growing an $80 billion base at 5%. You have to add a lot of revenues every year, which means you need to reinvest a lot of that into R&D.
And thinking about R&D and how much money you spend on it, Aradhana, we asked lots of CEOs and CFOs about return on investment in AI, and there's so much excitement about what this can do in drug discovery and all kinds of associated things. How excited should we be about the ability for AI to make a step change in this industry?
So we are using AI across the board. There is AI in drug discovery, which is really the very first step, you could say the top of the funnel, where there is opportunity for AI to improve the failure rate. Again, failure rates are very high. A drug in research, there's like less than a 2% probability it makes it to the market. But also we're using it for productivity, same as everyone else. But the thing that probably is where most transformation can happen and probably is the most unexplored at present is we need to still do phase 1, phase 2, phase 3 studies, right? There's no way to shrink the amount of time you need to study a drug in patients and see whether the hypothesis is correct or not. However, if there are better tools to do that or somehow shorten that time frame or make it very targeted like this Claudine 18.2, which is a subset of gastric patients, that could become a thing where you can actually get faster drugs to market.
So how do you use, you're the CFO. Are you like, use all the tokens you want, kind of just, is it a horsepower thing? How do you think about the cost versus the kind of the benefit right now?
So we definitely want to monitor what the return is on the investment. I think on some of the productivity initiatives, the return on investment can be pretty quick.
Are you seeing it already?
Probably not just yet.
Right.
But when I say productivity, I mean things like, balance sheet reconciliation.
Okay.
Right? Though somebody's doing that, that can be done quicker.
Sure.
So smaller productivity initiatives. I think for the bigger things like will it really impact clinical trials, that will be a long way before we actually start to see that. So what we're trying to do in the company is give the right tools to the right people. Everybody doesn't need great horsepower model in, if you're doing balance sheet reconciliation, but somebody in drug discovery may need something like that. So trying to balance that.
Okay, and I can't let you go without asking you about UK politics, given, UK listed business and what your thinking is around a new administration, new leadership at least of this administration and the priority. He's talked a bit about planning, talked a bit about science and the role of science, but I wonder what the message is this morning. Probably room to influence policy quite a bit at this point.
Yeah, I think, again, we've been around a long time and we work with every administration. So we look forward to working with the new government as well. And for us, the priorities remain very much innovation focused, investment in the innovative healthcare industry and incentives to grow in the UK.
Thank you very much, Aradhana. Thanks for joining us, the AstraZeneca CFO, Aradhana Sarin. Let's talk about where we are on these markets in a little broader context. Markets in 3 minutes on the opening trade with Skylar Montgomery-Koning of the Markets Live team. Skylar, good morning. It's a new week. It's a really busy week ahead. What are you looking ahead to?
Yeah, I think the two most important things I'm looking at this week are the Fed and the Bank of Japan. And that's because there's a relatively low bar for a policy surprise, particularly for the Fed. Now, what the market is thinking is that there's around 8 basis points of hikes priced in, which means that regardless of the decision, that pricing has to shift, right? If you have more in line with economist consensus that they hold at this meeting, that view is largely based on this idea that, you haven't seen big inflationary pressures feeding through from oil prices yet. We had a CPI print that was a bit on the softer side last month, and that means they have a bit of space now, whereas the market thinking in terms of pricing that 8 basis points is we want to show inflation fighting credibility right away from a worse perspective. So if you do not get that hike, then you're going to see the dollar under pressure, bonds buoyed, and you get the opposite result if that does come through. For the Bank of Japan, it's because we've had signals from authorities more so lately that they could speed up the pace of tightening. And that pace is very slow right now. It's every 6 months. The last hike was in June. The next one's expected in December. And the market's just not believed them because they haven't done that previously. So if we did get that signal for September, you could see a big move in JGBs.
What else are you watching this week? There's a lot of tech earnings.
Yeah.
Something to watch out for. Tech's all over the place at the moment. The oil price is all over the place at the moment. The market feels really uncertain about a lot of things at the moment.
Yeah, I think with tech earnings, it's always very hard because we have such a high bar for them. And yes, they continue to beat them, but the market still struggles with it in that it wants to see what the forward momentum is. And there's really a big question now around who will be the winners and losers within AI. Not all companies can have the massive amounts of spending that we've had go into a high return on an investment. So there's really big questions around that. We'll get more information through the earnings season, and this is the heaviest week for both Europe and the US. But I think there's still quite a high bar for those earnings to feed into price momentum.
Let me ask you about FX. We've got the dollar on the back foot this morning as a result of oil prices on the back foot and the tensions ebbing at least a little bit in the short term in the Middle East. What does that tell us about the FX story from here then, Skylar?
Yeah, I mean, it's really, really dominated by what's happening in terms of trade. And it's actually relatively unusual for terms of trade shocks to feed into FX in such a large way. If you plot the month-to-date change in FX versus the month-to-date change in terms of trade, the R-squared is something like 90% for G10. And there are some really interesting points here in that for Europe, it's not just about oil, it's also about gas, which, yes, it's come down today, but it's still very, very high. And that terms of trade deterioration that we saw in March and April, that's still very much present in Europe. For the dollar, it means that, you're going to get some more weakness today. But if Europe is under pressure from gas prices still, then, the dollar will still be.
Skylar, thank you very much. Skylar Montgomery-Koenig from our Bloomberg Markets Live team. We'll be back with the market open. European equity market futures are pointing substantially higher. We have a lower oil price. 90 is the handle on Brent, down by 6.8%. We'll watch that filter through at the start of European trade. This is Bloomberg.
Couple of minutes to go until we start the Monday session. New week coming up, last of the month, so we'll just focus on what exactly we saw Friday, and then we'll talk about what we see Monday. A couple of reasons why European futures are sharply higher this morning, one of which is the oil price. We'll get to that in a second. The other one is this chart here. You want to have a good set of futures, you probably have a bad cash session that came before it, and that's certainly what we saw at the back end of the session over in the United States on Friday. Chip stocks in particular under significant pressure. So fast forward, get through the weekend. De-escalation when it comes to the Middle East. Oil prices are down pretty sharply. That points to a European futures picture which is much more positive. London. So London's going to see, I think, today probably some weakness when it comes to what we're seeing out of the oil trade. But I think Astra's the pivotal point. We're just talking to the CFO. But Eurostoxx 50 futures are up 1.1%. Futures FTSE futures are a little bit of a laggard. Oil price DAX is up by 1.4% going into the session this morning. So there's a lot of positivity being priced into the European picture this morning, Anna.
Yeah, let's have a look at some of the individual stocks then in focus. You mentioned AstraZeneca. Let's start there. Perhaps the key line that we got from the CFO just moments ago then, Guy, was confirming that they are still targeting that big revenue number of 80 billion. So that's interesting, $80 billion sales target. So they're still targeting that. No upgrade to that, but that's still perhaps the top line, along with the key performance or strong performance in some of their oncology drugs. Vodafone in focus as well. Their largest market, Germany, they've seen their numbers coming in better than expected there on the service revenue growth side of things. So that is going to be something that perhaps will send things positive at the start of trade. And we'll also watch Argenx, the Dutch biotech business, expanding in immunology with an acquisition of more than $2 billion. So we'll watch that as well. Guy.
Okay, let's show you some numbers. Let's give you an idea of what's going on. It's expected to be a lot of green on the screen this morning. Let's see just how much there actually is. London is going to be a laggard. It's going to be an oil trade for the London market this morning, so it will not do as well. But Astra is going to be critical. I've seen calls flat. I've seen calls plus 2%, maybe even higher. So we'll see what effect that has in terms of the London performance. Stock 600 is up by 0.2%. Wait till we get Germany going. Wait till we get some of the more energy-focused markets going. I suspect you're going to see a bigger performance story coming through out of Europe. The euro's been up this morning. That's also a factor to bear in mind as well. The IBEX is up by, let's call it 1%. The AEX is only up by 0.3%. I'm curious to see what ASML does this morning. It is going ex-dividend, so just be aware of that when you look at the numbers on the screen in front of you. CAC's up by 9/9% now. We await the Germans. We'll get to them in just a moment. Anna, what does the sector story look like?
Yeah, let's have a look at where we are on the sector picture. And everything is moving higher, apart from for energy. And perhaps that makes a lot of sense because, well, it certainly makes a lot of sense with the oil price down by 7% this morning. So we've got an 89 handle on Brent. So as we've come into the London morning, the Brent price has continued to weaken, and that weakening has picked up. So we're down by 7% on the Brent price, which means that energy stocks are weaker by more than 2%. as a whole. That is perhaps something that's going to weigh on some of the London market to some degree at least. So BP down by 3.8%. We've got Total Energies down by 2.7%. We've got Equinor down by 5.7%. So there's some substantial movers within that. And of course, the other side of that trade is that travel and leisure goes higher. So travel and leisure stocks up by 2.4% on a calmer weekend in terms of those attacks we'd seen between the US and Iran. Retail also an area of strength. Utilities is an area of underperformance, along with food, beverage and tobacco. So that's the picture on the sectors. If you look at the individual moves, you can see that energy story certainly to the downside, and Safran and SAP a mixed bag to the upside, Guy.
Yeah, the energy's up quite a little bit. We're going to see it reporting numbers a little bit later on, so there's things to look out for in the latter part of this session coming through. ASML's up by 0.6%. So we'll factor that into our thinking as well.
Absolutely. Let's talk to Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth, who's with us this morning. Patrick, good to see you. I asked earlier, Becky Chin, how she keeps up with the volatility in oil prices, and you just need to have a portfolio that's going to work whatever the oil price is, and is that possible? How are you thinking about this big drop in oil prices this morning?
So we're overweight to oil and gas stocks, so it's going to be a bad day for us on that, but any bad day for energy stocks is usually a good day for everything else. So I view our oil and gas holdings as a bit of a geopolitical hedge that ideally we're not making money on them. Something's probably gone bad in Iran if we are making a lot of money on them, but I like them there as a ballast. That there's a lot of twists and turns, I think, in the Strait of Hormuz. It's not going to be clear sailing, unfortunately. They're not incredibly expensive. If we do see refining margins collapse, they'd be very expensive, but I do think we're in an environment where inventories have been drawn down to really low levels, and even if we do get a relatively open Strait of Hormuz, it is going to be a restocking phase that will support oil prices.
OK, so this isn't something that even if we reopen the Strait goes away very quickly. And I know that we'll come on to talk about the AI trade and everything to do with technology, because I know we've got a lot to talk about there. But just lingering for a moment then on energy, I mean, how does this play out for your European asset allocation if we see oil prices, say they stay around $90? I mean, who knows, but that's where they are this morning.
I think that's a headwind for growth, but not terribly so. If you see a spike higher, that really hurts growth. It puts central banks in a very difficult position because they've got the inflation problem, but it is something that maybe they should be looking through because it's a transitory war-driven thing. So at $90 is at the high end. There's a geopolitical risk premium in there, but the good news for the economy would be below that. The bad news would be above that. I think that's the point where the economy can manage things without too many consequences.
So about chips.
Okay.
Have we reached peak chips?
I don't think so. I think we still have another 12 to 18 months ahead of us where demand significantly exceeds supply. You've seen CapEx from the high bandwidth memory companies, but that's 18 months before that comes on. I do think so. I don't think we're in a secular thing where you're going to have the data centers continue. I think there's probably going to eventually have to be some consolidation where there's some winners, somebody eventually gives up, but none of the hyperscalers are in a position where they can give up right now. So they all have to accelerate their spend. Even if they weren't planning to accelerate their spend, the higher prices is forcing more CapEx, and I think there's still a long runway ahead of us.
We're starting to see, there's a lot written on the terminal about this morning, that NAND prices are beginning to roll over. Like the Chinese are starting to come in. They reckon they may have the market kind of at equilibrium by somewhere around 2027. Like, is that the point we're heading for?
We'll probably get there. I don't think I'm picking up pennies in front of the steamroller right now, but it is something that you are going to see profits go from ridiculously strong. Like Micron's at 87.5% profit margin. I don't think we get to a thing where they get to zero again. I don't think that there's that kind of supply coming on. But demand is going to keep accelerating. Supply is going to catch up, and we're going to get into an environment where these companies are profitable, but not ridiculously profitable, and the multiples they trade at, I think they're very fair for peak earnings.
We're at peak earnings now?
I don't think so. I think we still have another 12 months ahead of us, and I think we're still seeing accelerating earnings because you charge what you want. The hyperscalers need it desperately, and they set the price.
Yeah, so we're still trying to work out where the profits accumulate within that particular supply chain, aren't we, Patrick, when it comes to the hyperscalers and all of the various types of chips? And you've clearly talked about HBM. What about other parts of the AI trade that are not quite so specifically AI? So I'm thinking of the infrastructure trades, grids, for example.
I think that's the same thing. It's just there's a scarcity there for electricity. So we've just added Siemens Energy to the portfolio this month. GE Vernovia is something we've got. It didn't. The demand backdrop that they outlined with their earnings was incredible. I think they had some missteps on company-specific issues, but it's an area where there's going to be huge pricing power. So the high bandwidth memory, electricity, the infrastructure, all of those come together, and I think we've got $1 trillion of spend on data centers. You want to be in the beneficiaries of that.
So what does the uptick in either profits or top line look like for those kinds of businesses versus what we've seen in the memory sector and the hyperscalers before that? You know, what kind of expectations should we have for grid and infrastructure companies and the way they can turn this theme into something impressive for investors?
Yeah, they're traditional value type companies, they're industrials, but you're getting well above 25% revenue growth, and that should translate into higher than that earnings growth. And I do think there's just as long, probably longer even on electricity, because it's not just data center demands, but that's the incremental driver of these things. So both those sectors don't look incredibly expensive. Both of those have very high growth. Equities as a whole are incredibly expensive. And the reason to be in equities is you want to buy the equities where the growth is being generated. That's the attraction of equities right now, that you've got 20% earnings growth over the next year. Consensus numbers are forecast at. You better be in the stocks that are generating and beating that if you are being in equities.
Is that easy to do right now?
Well, those two sectors right now are the two I like because they're incredibly high growth, and the multiples don't look demanding to me.
Why don't the multiple? So this is the big.
Because they are cyclical still. It does come back to you've got to price cyclical companies based on peak profits. They don't deserve a market multiple. But should Hynix be at 6 times earnings? Should Micron be at 9 times earnings? I think that's a bit too pessimistic, given that I think they have several quarters ahead of us of probably blowout numbers.
Equities are incredibly expensive.
Yeah.
How expensive? There's so much written at the moment about...
83% of the time, equities are cheaper than they are today on earnings, forecast 12-month earnings. 99% of the time, equities have been cheaper than they are on a price to sales. But that's probably justifiable because profit margins are unprecedentedly higher right now. So I think you've got to have the companies that are generating all-time high profit margins, all-time high earnings growth forecast. If you are going to pay the big multiples for equities, that's the draw, basically, of equities. So I think you've got to be positioned in the companies that are generating spectacular earnings and revenue growth.
And Patrick, in those forward earnings and those all those measures that you referenced, are we factoring in the right cost of capital? Should we be thinking about a higher cost of capital, given what people tell us around this desk about how the energy prices won't retreat back to where they were?
Yeah. So we've got the Fed this week. It does seem to be a live meeting. I don't think the Fed hikes this year, but the market's pricing in 1.5.
Not even September?
I don't think so. But we'll see. Walsh is making every meeting interesting because there's not much guidance. And there are people who want to hike. There are people who don't want to hike. I do think if you're hiking because of the Iran war, that's something you shouldn't do because you are getting the growth headwind from higher oil prices as well. And I think that'll be the narrative that stops the hikes happening because a lot of the inflation is coming through from oil prices. But, yeah, it's very plausible. We do have a higher cost of capital, and that changes things for the companies that have to borrow. So I'm not a big fan of the hyperscalers. They don't have free cash flow anymore. Oracle's got huge negative free cash flow. So companies that are built their business model where they have to borrow to fund it, those are the companies that are at risk.
What comes after? This is the we've got a few more quarters and then we get to peak. What comes after that?
An ROI boom for all of the users of AI. Is that what we get to?
If you're on the hyperscalers, you believe this is productive spend and you're going to have incredible revenue growth and new products and innovation and productivity. That's the part of the equation that I'm not so sure about.
Okay, so you put hyperscalers over here in the I don't want them bucket. At the moment, you're in the I want to be in the picks and shovels, the businesses that are benefited. But you see that only for a few more quarters. So when you look ahead beyond a few more quarters,
well, I do. I don't think it
like?
does fall off a cliff. I think the hyperscalers continue to spend, but I think market forces will stop them accelerating their spend unless they've really monetized it and generating the cash flows. And I think that's where you don't get into a massive glut, but you don't have incredible pricing anymore. So it's still, Micron's a different company than it was 4 years ago because I do think we have a decade ahead of us where high bandwidth memory is going to be in high demand.
Sure.
Micron won't have a monopoly position and it is a commodity. but there will be profitable returns for these kind of companies rather than no returns, which you get to with commodity companies in the past. So I do think it's changing from supply demand going from boom to bust to where there is much more structural growth on the high bandwidth memory, the processing. The data centers continue, but not at the accelerating rate that we've seen over recent years.
Great to see you, Patrick. Always a pleasure. Genuinely interesting. Thank you very much indeed. Patrick Armstrong, Preliminary Wealth CIO. Let's take a look at what the core of Europe looks like this morning. Very strong growth, as you can see. Nestle on the right-hand side is understandably, after actually quite a lot of sort of volatility last week, doing nothing. Elsewhere, there's some strength in there. Look, tech's definitely on the front foot. ASML is up. LVMH is coming through with some numbers a little bit later on. The luxury, there's some really interesting pieces being written on the luxury space on the terminal this morning. Check them out. So that's what the picture looks like. Let's find out what else we are watching. Alex is here with some details.
Good morning, Guy. Well, do you know what? Let's start at the very top, as it were. Let's go out of space first. We're looking at SES, the Space Solutions, think satellites firm. They were given some breathing space, some industry incentive payments following a decision by the FCC in the US. We're seeing them up this morning around 5% in the green. So starting high, let's bring things a little back down to earth and look, of course, at oil. And we know across the energy sector, the weekend's easing tensions between Iran and the United States, that sort of pause in hostilities has seen oil prices this morning down. We're looking across here. You can see BP, quite sharply down, among others. So red across the board when it comes to the energy majors here in Europe. That, of course, an extension of the geopolitical situation. And let's just turn finally to Vodafone. They beat analysts' estimates with the first quarter services revenue, particularly coming from Germany. That's the phone operator's largest market. They are up just over 3% this morning. So, yes, from space to geopolitics to the phones in people's pockets, that's a little bit of a snapshot of what's on the move out of the gates this morning.
Alex, thanks very much. Bloomberg's Alex Morgan there with a look at some of those stocks that are on the move this morning. Coming up, AstraZeneca, one of the companies in focus, reporting higher than expected profit, lifted by cancer treatments. We will dive into the numbers from the British drug giant. We were talking to the CFO. She confirmed the 2030 guidance. What's next for this business then? This is Bloomberg.
Our expectation is, between this decade will grow 5-6% on a CAGR basis, and we will maintain that level of growth, which is sort of top quartile in the next decade as well. Products like Sony, where we just announced the results, we need to continue to invest about 24% of revenue into R&D to not only get to 80, but continue 5% growth beyond 2030.
AstraZeneca CFO Aradhana Sarin speaking to us just in the last hour. This after the company reported higher than expected profit, buoyed by cancer medicines. The drug maker also released promising results for an experimental treatment for gastric cancers, but disappointment in some other areas. Let's bring in Bloomberg health reporter Ashley Furlong with us to digest what we've heard from AstraZeneca this morning. Good morning to you, Ashley. So we heard Aradhana there talking about, R&D, talking about top-line growth, a lot of news lines in this. What stood out to you?
It's really a story of continued growth for their cancer medicines. And under Pascal Soriot, the company's really become a cancer drug powerhouse. But what the questions increasingly are about is whether that continued growth in cancer can sustain them into the post-2030. So they have this big target for 80 billion by 2030. Analysts are increasingly saying that's easily reachable. But the question is going to be after that. Can they maintain that growth? And we heard Aradhana earlier saying that she's very confident they can. Analysts are, still on the fence. They haven't seen the numbers yet for that.
So what are we looking for here? What are the details we're looking for here?
So a big part of this is also going to be about their weight management pipeline, so they have a large cardiovascular drug pipeline as well as weight management, and they're really trying to get into the obesity space. They have a whole lot of assets there, so that's going to be really important to the post-2030 outlook. Obviously, oncology, they need to sustain the growth. They've had a lot of really good partnerships. They have a partnership with Daiichi Sankyo, but we've seen results from today, which is from a drug that they developed in-house, which I think that they're really excited about, being able to show positive results from drugs that they've developed by themselves.
Can I ask you about how they communicate positive results to the market? Because did they come unstuck a little bit on this in the last 12 months or so with one particular drug? And we asked Aradhana about this, and she sort of said, we give you the top line, you've got to wait for the detail.
I think the issue is that AstraZeneca is so successful with clinical trials that when they have a trial failure, there's questions asked, what did you do wrong? And this is a part of, being a drug maker. There's trial failures all the time. But when AstraZeneca had that recent negative trial result, obviously another negative one today, that does hit sentiment harder than it would, I think, for another drug maker, which, more regularly posts bad results. So I think it's very much about that, and possibly also about some of the communication that they had around that trial. And investors, sort of thought it was a done deal when it really wasn't.
Stocks up around 1.5, being reasonably well received this morning, having a positive impact on the FTSE. Ashley, thank you very much indeed. Ashley Furlong, our health reporter. Let's talk about what's happening in the tech space. Huge week coming up in the tech space. Let's start off with what we've got today. The Chinese chipmaker CXMT soaring. I think that's... I don't quite know whether that sort of captures it. It's had an IPO this morning. It's a $9.8 billion IPO. The stock at one point I think was up kind of circa 500%. Yeah, just 500%.
I think that's soaring.
I think we call that soaring times 2 squared. Soaring squared. Investors certainly are flocking to the stock. Ahead of what is going to be a big week. We've got many of the hyperscalers reporting numbers this week. We've also got a memory chip story, which I think we're paying a great deal of attention to as well. Anthony Stevens has been writing about all of this. So let's put it all together. Let's start, Anthony, with CXMT. That was quite the IPO.
Yeah, to use your word, this IPO captures China's soaring ambitions in tech. It's their largest play thus far in the tech space in terms of IPOs, the second largest IPO of all time in China. And at the highs, it was China's biggest company. It's come off a little bit since. Now, what's interesting is how this thing was priced. It was priced to do well. China has been very reluctant to allow tech companies to price at adventurous valuations, like in the US, for example, to risk losing money for retail. So this deal was priced really well. It's trading really well. It was 200 times oversubscribed, which is kind of becoming the norm for China, but still stands out against the rest of the world. For example, that's 10x SpaceX's retail tranche, for example. This dynamic has really supported tech IPOs in China. We had a lot of double-digit gains, triple-digit gains, and most recently, like 200, 300% gains. So this is becoming normal, but given the scale of the IPO, it's massive. Why is this important? CXMT is a structurally important company to China. They produce the DRAM chips that their latest LLMs need. They don't have any domestic HBM. They cannot build it even if they wanted to. So CXMT and the DDR5 that CXMT provides is going to be absolutely pivotal to China's AI ambitions.
Okay, so CXMT is primarily a DRAM manufacturer, but you've been writing about NAND memory, Anthony, and how maybe this is a canary in the coal mine. Explain to us your thinking.
So we're at this moment in time where everyone is building out CapEx, whether it's the hyperscalers or the semiconductor manufacturers themselves. And this kind of CapEx has to meet increased demand. Now, so far, we have been very relaxed about that. The build-out of capacity has met pretty much unlimited demand. But there comes a point on the frontier where the increased supply starts to eat into the cyclicality of what you're producing. And the earliest signs that we've seen of that dynamic in the AI trade has been in NAND. NAND prices have started to stabilize. They're dropping a little bit. We have some analyst reports from sector specialists that maybe the backlog starts to clear in 2027, and you start to see a little bit of a demand-supply equilibrium. Now, investors have really materially repriced that. Kioxia, for example, is the poster child of that sector. That's off around 40% from the highs. At one point, that stock was Japan's largest stock by market cap. So you can see how euphoric people got at the top and how kind of morose they're getting as capacity comes on board. So this kind of AI trade, whether it's a cyclical or structural demand, is a really big question into the earnings season that we're heading into.
We're heading into the earnings season. We're kind of already in it, but we get a big kind of lump of it this week. Hyperscalers, what am I watching for?
It's an absolutely massive week, not just on the hyperscalers. So you have 4 out of 7 of the Mag 7. You have Samsung, you have Hynix, you have Kioxia, you have Teradyne, you have Qualcomm. It's insane. It's from front to back. The entire AI ecosystem tells you what they plan on doing with CapEx, what earnings look like, what demand looks like. And more importantly, as the dispersion within the AI trade picks up, it tells you these micro trends. Are you using more HBM? Are you using more DRAM? How are the chips fitting together? Where are the supply chain bottlenecks? These are the next step iterative questions that the AI trade investors are asking now, because the days of AI going up and down together are long past.
Yeah, and it's not all about all the picks and shovels. It's about one pick versus this shovel and what you make of all of those. Anthony, just briefly then, Nvidia and the story there, lots of reports suggesting that they are considering supporting OpenAI as OpenAI makes commitments to SoftBank around a data center in Ohio, one of the world's largest. What does this tell us? Does it make us more concerned once again about the circular nature of these deals?
Yeah, it's a very ambitious piece of financial engineering, right? It's a backstop to the credit quality of OpenAI that allows the creator of this data center, SoftBank, to get better financial terms. Now, credit for SoftBank has been kind of weakening. CDS of SoftBank has been traveling higher. Hyperscaler CDS in general has been weakening, as there is concern about the viability of this CapEx build-out and the huge sums that are being raised in the debt markets to fund this build-out. So this kind of financial engineering is becoming more common. It's called a credit wrapper. It allows some of these cash-rich semiconductor companies that are earning money right now to bolster the balance sheet of their customers to allow these multi-year financing plans to continue. So whether we see more of this down the line remains to be seen.
Anthony, thanks very much. Bloomberg's Anthony Stevens with the latest on all of those tech themes ahead of a big tech earnings week. Coming up on this programme, what earnings in Europe's industrial sector reveal about the continent's AI build-out? We'll discuss that with Daniela Costa from Goldman Sachs next. This is Bloomberg. This is the opening trade this Monday morning. 30 minutes into today's session, we've got European equity markets firmly on the front foot this morning. In particular, the Xetra DAX up by 1.2%. The energy sector is by far and away the biggest losing sector today, but even that is not managing to take all of the gains away from, for example, the FTSE 100, which is up by 0.4%. So energy is by far and away the worst performing sector. There's only one or two sectors in negative territory, Guy. Broadly, all of the other sectors are in positive territory as we price in a much lower oil price. We've got a 90 handle thereabouts on Brent, and that obviously has a big impact on European companies and their cost base. What are you seeing?
You certainly see that in the internals. 454 stocks are up in the Stock 600 this morning, only 136 down. Some of those will be energy stocks, certainly some heavyweights there. Volume's reasonably good. Let's talk about some of the winners that we're watching. AstraZeneca, we had the CFO on the show a little bit earlier on. Market likes the numbers that we are seeing. Probably would have liked an upgrade to the outlook a little bit more, but nevertheless, happy with what we've got. The market's up by 1.6% on Astra. SES, this is to do with incentive payments, bandwidth incentive payments in the United States. It's up quite nicely. Inditex, I think that's an upgrade, up this morning by 3%. We get LVMH after the bell today in the luxury space. Watch out for that. Let's talk about Polish convenience stores. 7&I is backing away. It seems from Zabka Group that stock is down by 11%. I don't talk enough about Polish convenience companies. Shell, AP Møller-Mærsk, more straightforward. Both of these two companies obviously tied into what we're seeing out of the Middle East this weekend, a pause in fighting, though we are still seeing significant tension, particularly in the Red Sea this morning. AP Møller-Mærsk is down by 3%. Shell is down by 2% right now. Anna, what else are we watching?
Let's get an update on exactly those developments in the Middle East. Oil and gas prices are then dropping sharply this morning as the US and Iran hold fire after weeks of escalating tensions. The US military has held off strikes since late Friday without explanation or announcement, while the Tehran has signalled it was refraining from any retaliatory attacks and held talks with Oman over the Strait of Hormuz. Firefighters are battling wildfires for a sixth consecutive day in France and in Spain. More than 300,000 people have already been evacuated from those two countries, with another heat wave set to complicate efforts to fight the flames. French President Emmanuel Macron will hold a crisis cabinet meeting later today to discuss the response strategy. And back in markets, the CME Group is launching single stock futures today, giving investors a new way to bet on more than 50 of America's biggest companies without buying the shares. The contracts let traders hedge or speculate with leverage without the complexity of options. CME is betting the rise of retail trading will mean the product is a success after its original launch 24 years ago failed to take off. Guy.
OK, let's turn back to some of the corporate news that we are watching. Nvidia is reportedly in talks to provide a guarantee of around $250 billion of financing for OpenAI. The Wall Street Journal says the deal should help OpenAI lease a 10-gigawatt data center hub that SoftBank is developing in southern Ohio. Jensen Huang spoke to Bloomberg's Ed Ludlow in San Francisco about the constraints on the semiconductor industry, which he believes will need to rapidly expand to meet AI demand.
The semiconductor industry has really changed. And the reason for that, because we used to build computers for people to use, and we're going to still continue to build incredible computers. These are now processing AIs for humans to collaborate with. But in the future, we also have AI agents and robots, and they're going to be using computers. So instead of just a billion people using computers, we're going to have 100 billion agents and billions of robots all using computers. The computer industry, the chip that's built on top of the chip industry, surely is not big enough. And so this is one of the realizations of the semiconductor industry, that now computers are built not just for people to use, but computers are being built for computers to use. My guess is that the semiconductor industry is probably going to have to be 10 times larger than it is today over the next decade or so. And so working with our partners in Korea and around the world to scale up the supply chain of semiconductors so that we're prepared for this AI future is really important.
As, of course, the Nvidia president and CEO, Jensen Huang, speaking to Bloomberg's Ed Ludlow. Let's now shift our attention from Asia to Europe's evolving AI build-out. Earnings from European industrials this week will give a key indicator on how companies are positioning themselves on the infrastructure side of the build-out. Joining us now, Daniela Costa, European Capital Goods Equity Research Head at Goldman Sachs. Good morning.
Good morning.
What should we be expecting?
So we have had so far a very good reporting season, actually. Almost more than 90% of the companies that have reported have beaten expectations on orders by a magnitude of about 10%, really one of the most positive seasons we have seen since the pandemic. And we expect more of a continuation of that as we enter this season. We have some of the bigger data center exposed companies like Schneider Electric and Prysmian reporting this week. And we are expecting to continue to see that strong trend of upgrades of outlooks.
How long does this continue for? Like, the data center build-out story just seems to go from strength to strength to strength. Do these companies just continue to benefit on an ongoing basis from that data center build-out?
I would say in the next 2 years, on an absolute basis, we do think we're going to continue to see very strong numbers. So this year, in the first half, for some of the companies we cover, we've seen triple-digit growth. Of course, the comparables are getting tougher and tougher, and the second derivative will be slowing down. But we still have double-digit growth and big numbers, about 30% on our CapEx trackers for next year. So a lot of that is capital that has already been committed for this build-out. I think then when we go further beyond that, we continue to see this industry strong, but it's more likely that we will also get into some points where we might see overcapacity in terms of the build-out of equipment.
Okay.
That's interesting, because I was going to say, is the strength that we're seeing in the likes, well, the sector at least, that contains Schneider Electric, Prysmian, is the performance there attracting new entrants or causing other companies to try and step in and take on these companies within the electrical components space? What's the competitive environment look like?
Yeah, I mean, for now, everyone is seeing extremely strong growth, and I would say we are seeing the incumbents investing more and more in adding up a capacity. So this year and next, we still feel we are pretty tight. Let's take the example of fiber optics, for example. We see 10-15% under capacity, but we have seen an incredible amount of announcements. Some companies tripling up their capacity by the end of the decade. That obviously will balance things out, and when we look sort of beyond 28, then the environment might change.
Yeah, what's the constraint on their growth, these electrical components businesses? What's the thing that means they can't grow faster than they are?
It takes time to build. A lot of these things sort of take 18, 24 months from when you make the capital decision to actually having it on the ground, then another year of homologating, testing factories, making sure the product is coming out all right.
So it's not. Is it construction per se, or is it, as you say, the testing phase? I'm just wondering, because we talked about the data center build out in the States and other places where actually a shortage of construction workers is part of the narrative there.
Yep, 100%. Construction has definitely been a bottleneck. Also specialized labor, manufacturing labor in the Western world, which is where a lot of this capex is happening, especially in the US, has been a bottleneck.
We think about some of this as being kind of AI related, but it's broader than that. It's broader than that, isn't it? It's electrification, which is in some ways potentially more sustainable. We are electrifying the global economy. It's part of that is AI, part of that is data center build out, but there's also just a general process of electrification that is underway. Does that make this sector more stable over the medium term?
Yeah, I think you touched an important point there, actually. So if we think about data centers, utilities is basically one of the big bottlenecks in terms of getting that capacity live. And the problem there existed before. We had aging grids in developed markets. So the two things go hand in hand. And clearly, I would say the utilities part of this build out is not just about data centers, about an aging grid, the need to have more interconnections, also energy security and the geopolitics and tied to that. So in that sense, I would say at least the next 5 years, the whole electrification topic, we expect to be sort of growing on the high single digits.
And Daniela, what does the sector that you cover tell us about the global growth story? I mean, these are all really positive themes around data center build out and electrification. All of that sounds very structurally positive. What's happening cyclically? Are you getting any clues as to any areas of weakness or just no, not at the moment?
That is the interesting thing, actually, this reporting season, because I would say over the last 15 months, we have had great news on data centers, but not on the rest. The cyclical parts were going through a destocking last year. China was weak. This year, the reporting season is actually strong more broadly than that. We have actually seen even truck companies showing positive results, exceeding expectations. But I would say the effect of this build-out, it's spreading. So data center, semis, and utilities used to be about 20% in 2022 of world capital expenditure. Now they're 40, and they create probably an even bigger magnifying effect to the side of it. So it's spreading all over, and it's becoming more difficult to differentiate this build-out just from the broader capital goods. I would say where we're seeing weakness mainly is probably on the consumer side.
What's the macro read of all of this? What is it? What are you? If I'm looking at all of these companies, what is it telling me about the global economy? What is it telling me about what is going on in terms of the durability of the growth rates that we're seeing at the moment? Yeah, we're seeing weakness on the consumer side. We've probably known that for a while. But how much momentum does this have?
Yeah, I mean, I would say, as I've mentioned, if we look at least at the next 4 years, we think capex is going to grow at high single digits. Even if you take out the data center specifically, it's still mid-single digits. Okay. Broadly double of what we've grown in the last 25 years. So this is really creating a big magnifying impact.
Do you think the market's valuing this stuff correctly? You look at the UK, it's full of industrial companies, yet it takes an American private equity company to come in and buy it to actually give it the kind of the valuation. Why are we still struggling to value some of this stuff?
I would say the UK is in a very specific niche. If we look at the European capital goods on average, we are now trading at a 40% premium to the stock 600 on 12-month forward PEs. We used to trade at half of that multiple. As I've said, sort of double the growth, the multiple. If we keep this growth pace that I've suggested, I would say we're sort of fairly valued. There are pockets like the UK where there are other geopolitical things around that might impact. But I would say in general, industrials in Europe have re-rated on the back of these opportunities.
Yeah, and you've mentioned that you cover truck companies, which sometimes do give us some really interesting signals about the economy. I wonder if the story around self-driving, whether that is, what does that look like to you, and who benefits and loses from the parts of that truck ecosystem that you cover?
Yeah, I mean, this is a very, very emerging topic right now. I think where some of the truck OEMs are talking about in the U.S. launching the first autonomous trucks by the beginning of 2027. We haven't sort of really seen how the business model is exactly going to evolve. Probably you're not going to be selling a truck for the sake of just selling that one product. You're going to sell the whole mileage ecosystem. I think we will probably see less units of trucks, but more service because the equipment's going to run 24/7. And with that, I think the companies that have the strongest market shares with the largest fleets in the U.S. that adopt this will see the benefits. But that's going to be a very interesting topic next year, but we haven't really seen the glimpses of it so far.
Daniela, very nice to see you. Thank you very much indeed for stopping by to see us. Daniela Costa, Head of European Capital Goods Equity Research, joining us from Goldman Sachs. Coming up, hundreds of thousands of people have been evacuated as wildfires spread in France and Spain. We're going to have the latest next. This is Bloomberg. .47 past the hour. Welcome back. You're watching the opening trade. This is what the equity situation looks like in Europe this morning. Positive. A little bit of dispersion. German market certainly having the best of it this morning. We are seeing the energy price being factored back in, but you've also got a corporate earnings story that looks fairly positive as well. So energy prices are lower, corporate earnings look fairly positive. Generally, that is translating into an up equity day. Whether it sustains or not remains to be seen, but the US futures picture at the moment also looks quite positive as well.
So that's the markets picture right now. In other news, more than 300,000 people have fled their homes in France and Spain as wildfires threaten the major cities of Madrid and Bordeaux, and as a new blaze erupted in eastern Spain. Let's bring in Bloomberg's Caroline Conan, who's in Paris and has been following these stories for us. Caroline, bring us up to speed with the latest.
Yes, so the massive wildfire in the southwest of France, in the Gironde region, is still not contained. It's still spreading towards the metropolis of Bordeaux, which has 265,000 inhabitants. Last night, the French Interior Minister, Laurent Nunez, was on French television saying, at the moment, we're not talking about the evacuation of Bordeaux, but we have to stay realistic. So he didn't rule it out either. The next hours for this fire are going to be very important because the temperatures at the moment are dropping. There is some light rain in the region, so the conditions over the next few hours may be a little bit more favorable in order to try and contain this fire. However, in just a couple of days, we're going to have another heat wave in France, so the window is very, very tight to contain this fire. So far, about 42,000 hectares have burnt in the region, a very wealthy tourist destination. That's, to give you a comparison, that's about 4 times the size of central Paris. In Spain, north of Madrid, you've got about 50,000 hectares burnt. That's a record in Spanish history for wildfire there. In France, more than 200,000 people have been evacuated so far. A lot of tourists, of course. You've got 8,000 people living there across the winter, more than 100,000 living there, going there during the summer. The airport of Bordeaux at the moment is still functioning, but the trains south of Bordeaux have been cancelled. So we'll monitor the situation over the next few hours. The next few hours are going to be very decisive to try and contain this fire to not spread any further.
President Emmanuel Macron is holding an emergency cabinet meeting today. What are they going to do? What can be achieved? if the fires can't be brought under control. You talked about, I can't quite believe we're talking about the evacuation of Bordeaux. Are these things on the table? How significant could the next few days be?
Again, the evacuation of Bordeaux is not ruled out at the moment, but it's not on the table either, according to the Interior Ministry last night. So the situation over the next few hours will be very, very important. President Macron, of course, is holding this new cabinet meeting, this new crisis meeting today in just about 1 hour. The army already has been sent on location in order to help to contain this situation over there. I was at the Tour de France arrival yesterday in Paris, and the Tour de France final stage was actually cut short because a lot of the military forces are in the southwest of France, so they were not available in Paris to try and secure the arrival of the Tour de France cycling race. And of course, there will be political questions, there will be financial questions. It is too early, of course, to measure the cost of this massive fire in France. We know that about 240 houses have been burned, but as I was mentioning, more than 200,000 people have been evacuated. In fact, we heard from the finance minister, Roland Lescure, just a few minutes ago, who was saying that the insurance companies, the insurers, are going to pay for the cost of all these people who were evacuated, including the tourists who had to relocate in the region, who had to cross sometimes by boat the Bassin d'Arcachon in order to escape the Cap Ferret Peninsula, because there is only one road going to this peninsula, making the work of the firefighters very difficult, and the evacuations there, of course, very difficult. But there has been a lot of political questions. One thing very interesting for you, Guy, is that there's been a political debate about using the Airbus transport military plane, the A400M, as a water tanker. And in fact, Airbus has made some kind of removable kit in order to make this possible. This A400M, used as a water tanker, took days to be deployed in the southwest, because at the moment it was in a testing phase, was supposed to not be in service until the end of July. And of course, the far left of Jean-Luc Mélenchon, the far right with Jordan Bardella, have been criticizing the government about this plane. Why wasn't it used earlier? And finally, over the weekend, the Prime Minister Le Cornu has decided to use this A400M in order to help with the water tanker and the Canada situation in the region. We'll have actually very interesting earnings interviews this week. We'll ask those questions. We'll have the Airbus CFO. We'll have the AXA CEO on Friday, one of Europe's biggest insurers, the biggest in France. So there will be a lot of questions here to be answered.
OK, Caroline, thank you very much. Caroline Conan with the update on what's happening on the ground. No doubt the politics and the corporate story will continue to focus on this for some time. Let's look ahead to some of the other things we're watching for this week then. It is a really busy week. Today, still ahead, we have German IFO business confidence, that key important indicator about the state of the German economy. We have a big earnings day for Europe on Tuesday. Mercedes-Benz, Barclays, plus Boeing earnings, all of that happening on Tuesday. On Wednesday, we get the Fed rate decision. We get corporate earnings from Microsoft and Meta, Qualcomm and SK Hynix. So it's not just US big tech. Thursday, we had a Bank of England rate decision, and we have results from Apple and Amazon and Samsung. So again, not just US big tech, it is global. And on Friday, BOJ rate decision plus Euro area CPI, Guy.
OK, let's take a closer look at what we are watching in these markets. Mona Conningham, editor of the Bloomberg Markets Today, joins us now. Huge week coming up. Set us up for it. What are we looking for? What are the big kind of events that we should be paying attention to? Anna's just run through the list. But how's the market positioning?
Right, we do have a lot going on this week, and reminding you that it's against the backdrop of fluctuating oil prices, huge amounts of uncertainty in geopolitics. The big events are going to be key central bank meetings. We've got the Federal Reserve on Wednesday. We've got the Bank of England on Thursday. And then, we've got the Bank of Japan as well. That is, there's various different factors going on. I think inflation is going to be a key one, particularly for the Fed and the Bank of England. there's been so much change since the last time that they met and the last time we had commentary. I think we're going to be looking for, is the resurging oil price going to impact inflation in a way that means that we are going to have a more hawkish bent? Will it give enough, particularly when you're looking at the UK situation, domestic inflation has actually been cooling. Does this disrupt that picture enough that we're actually going to see people leaning more towards further hikes faster? And in the case of the Fed, there is already a question about whether we would actually see a hike on Wednesday. At the moment, it looks more likely to be a hawkish hold. But there's certainly likely to be some dissent there. I think really what policymakers say and what that indicates about the path ahead is going to be crucial. And I think we could be talking about some quite different market bets by the end of the week.
Yeah, and the Fed, I mean, we've got a new Fed chairman who doesn't really want to say anything forward guidance like, and so that makes things more complicated. Do you think that it's all about tech earnings? We've got some earnings out of the luxury sector in Europe as well, with LVMH coming up just today, I think, later on today. So what's the earnings story look like?
Yeah, so the earnings story, I would say, is there's a high bar. There's two things. One is technology, which you mentioned. We've got, I think, 4 of the Magnificent 7 reporting this week. We've also got a couple of those key Korean tech companies. And there's a lot of focus on, is the spending justified? Are the hyperscalers overvalued? I think there's a real concern about momentum there, and that's driving a lot of the equity sentiment globally. And then we also have earnings from a huge array of companies, including some key luxury stocks, like you mentioned, LVMH today. And there, I think the bar is quite high as well, as a slowdown in spending in that area. So,
Moana, thank you very much. Moana Coniam, editor of the Bloomberg Markets Today blog. Still ahead, the team will be speaking to Clemens Fuest, who is, of course, the IFO Institute president. That's in just a few minutes' time, in fact. That on the German economy. This is Bloomberg.